Welcome to Talk Tickers. Today, we are diving deep into a pretty wild third quarter earnings report from Monday.com. That's ticker MNDY. So let's get right to it.
So check this out. On a day when the company reported what, on the surface, looked like a really solid quarter, this was the stock's final report card, a drop of over 12%. Ouch. And it left a lot of people scratching their heads. This is what we call a classic beat and drop. And it begs the big question, right? How on earth does a company beat analyst estimates on revenue and profits only to watch its stock just get totally hammered? Well, that is the puzzle we are going to piece together in this explainer. And here's how we're going to do it. First, we'll look at the headline results. Then we'll dig into their operational story and their upmarket momentum. After that, we'll pinpoint the exact guidance problem that really spooked investors. Then we'll put it all into a broader context. And finally, we'll wrap up with our take on what to expect for the next call, including our rating. Okay, first up, let's look at the numbers themselves, the stuff that came out before the market even opened. And honestly, it all looked like really, really good news.
So as you can see on paper, this was a home run. Revenue came in at nearly $317 million, a good $4.6 million ahead of what Wall Street was expecting. But the real showstopper was the bottom line. Their non-GAAP earnings per share came in at $1.16, which just absolutely crushed the 88-cent estimate. I mean, it was a clean beat on both of the most important metrics.
And beyond those headline numbers, management was really eager to talk about their strategic progress. Specifically, they wanted to highlight just how well their push into bigger, enterprise-level companies is going. And this tells the real story of what's happening inside the business. RPO, which is remaining performance obligation, think of it as a peek into future revenue, was up a massive 36% year over year. The number of big-time customers spending over $100,000 a year with them, that shot up by almost 50%. And those same big customers are spending 17% more than they did last year. This is the core of management's argument. Their big bet on the enterprise is paying off. The co-CEO, Roy Mann, summed it up perfectly on the call. The focus was crystal clear: record profits and smart, efficient scaling. They're telling investors, hey, we can grow and make money at the same time, all while building out new products.
This operational strength isn't happening by accident. It's all built on their product strategy. They're making this big shift from being just a single product company to a true multi-product platform. They're moving hard into CRM, service management, tools for developers, and now even marketing campaigns. It's this whole evolution that underpins their entire long-term story.
But, and this is a huge but, despite all that positive operational momentum, the market got laser-focused on one thing and one thing only. So let's get to the real heart of why the stock sold off so hard. And here it is, the Q4 revenue guidance. Management guided to a range between $328 and $330 million. So what's the problem? Well, the crucial point is that Wall Street was expecting something closer to $333.5 million. Now, in absolute dollars, it's not a catastrophic miss, but for a high-flying growth stock like this, it was enough to set off all the alarm bells.
And this right here is the key takeaway for anyone investing in growth stocks. Past performance is great, but the stock's price is all about what's coming next. The second Monday.com hinted that their growth might be slowing down, even just a little bit, the market completely repriced the stock, and they did it in a hurry. That strong Q3, instantly forgotten.
So, to really understand this reaction, we need to zoom out and look at the huge gap between the story management is trying to tell and the story that the market is actually hearing. This slide just lays out the conflict perfectly. On one side, you have management talking about record profits, fantastic enterprise metrics, and a big long-term vision. But on the other side, the market right now is completely zeroed in on just one thing: near-term, top-line deceleration. For stock in this sector, there is an incredibly low tolerance for any kind of guidance miss. It doesn't matter how strong the rest of the business looks. And this chart really puts it all into context. You have to remember, Monday.com was already a major underperformer before this report even came out. Over the past year, the stock was down almost 49%, while the broader software ETF was up nearly 29%. So investors were already on edge. Their patience was worn thin, and that guidance miss was all the excuse they needed to trigger another big sell-off. So, where does all this leave us? Let's turn to our forward-looking take and talk about what we'll be watching for on the next earnings call. All right, here are the 4 big things to keep an eye on. First and foremost, can they execute against this newly lowered bar for Q4? That's just table stakes. Second, we really need to see some actual signs of monetization from their new AI tools. Third, keep a close watch on that RPO growth number. It's still the best leading indicator we have for future business. And finally, any early data points on their new campaigns product will be super important.
Okay, so putting it all together, our rating is market perform. Look, the company is executing well from an operational standpoint, and their push into bigger accounts is absolutely real. But that growth deceleration is a huge near-term headwind, and it's just impossible to ignore until we see some concrete signs that it's stabilizing or, even better, picking back up again. Now for a plausible trade idea. Given this weird split between strong fundamentals and pretty weak stock sentiment, one could consider using something like long-dated call spreads. What a strategy like that does is it lets you participate in the potential upside if the growth story gets better over the next year, but it also clearly defines and caps your risk if the stock continues to struggle. It's a risk-defined way to play for a recovery.
And as always, please remember this analysis is for informational purposes only and is definitely not financial advice. You should always do your own research.